From Venezuela's limited oil impact to shifting economic signals across Europe and fresh concerns in the U.S. labor market, there's a lot moving beneath the surface in global markets. I'm Johanna Bota, and here to break down what's driving sentiment and what to watch next is Alex Ridgers, Global Head of Retail Dealing Desk at StoneX. Welcome back, Alex, and Happy New Year.
Hi, Johanna.
So I want to start with Venezuela because it's impossible to ignore. What's your view on the situation right now?
Well, there's a lot of headlines, and I know I like to be slightly contrarian in this. I think, someone has to be. There's so much talk, and it changes every day. What's happening? Are we taking another oil tanker? Are we not? The big standout for me in terms of what's going to impact the financial markets, because ultimately that's what we're here for. We're not here for the humanitarian side. Venezuela is really not important.
Okay.
They're pumping 1 million barrels of oil a day. That's it. So to get their oil industry, which is what we think Trump and everyone else cares about, to get that really back online, to be challenging, so to actually be pumping out massive oil reserves, it's going to take years. So from my part, I'm just trying to ignore it at the moment.
Okay, so what are you watching now then?
Well, I've been looking for signals. We just started 2026. What's going to be driving the markets? So I've been going country by country, quite a bit about Europe as well, because we don't talk enough about Europe, I don't feel. So
well, then let's start with the UK outlook then.
Yes. So UK, for me, is a really fascinating one. So where we start, we've got there's sort of this Bank of England panel, and what they do, they go and speak to business leaders, to CEOs, to see what's going on in their world, just to sort of judge the state of the economy. So from that sort of business panel, we saw last year approximately major companies cut about 0.4% of their workforce. And what's also interesting is that they're predicting to do that again.
Oh, wow. Okay.
So in a way, bad in some ways, but actually this is looking to be really good from an inflationary perspective. So when we were in 2023, we had wage growth peak at about 7%. And almost, if you read sort of Bank of England notes and comments, this has almost been almost the reason they haven't been able to cut rates faster, because with wage growth stubborn, almost to counteract inflation, it's just kept prices rising and rising and rising. So we said we were 7% 23, we're at 4.4% now for the last 12 months. And this, again, survey is predicting sort of 3.7%. So for me, it's a good sign. But almost from a UK perspective, all we ever talk about in the world has been inflation for the last few years. I'm not going to consider inflation for the UK. Inflation's done.
Okay.
It was a bold statement, but it's done. So in a way now, I think we're moving on to the UK from going, it's all about growth. Stop worrying about inflation. Let's look for GDP output, what's actually going to start kicking the economy into gear.
So what do you think it's the current disconnect then between the FTSE 100 and the FTSE 250?
Well, we've seen the FTSE be strong recently, and actually both be strong recently. And again, it's a fascinating thing that if you really want to invest in the UK, if the UK growth is strong, don't invest in the FTSE 100, invest in the 250.
Okay.
It sort of comes from almost a few angles, actually. When we look at the FTSE 100 is almost a play on sterling. We've seen recently, cable rallying, but actually in the last month or so, we've seen that stabilise. And for me, that's been the driver of the FTSE 100 rallying. So when we're talking about the 250, almost growth is going to make sterling stronger, and then a stronger sterling means cheaper imports, lower inflation, which again is good for domestic demand. So it's almost like a double play on the FTSE 250, where if we start seeing growth, it's going to shore up cable sterling dollar rate, which is going to have knock-on benefits. So that's said it's we can almost do the growth play, but we can almost do the sterling play, whether we invest in the 100 or the 250. Okay,
so that's the UK. Let's put that aside. Let's move on to Germany.
Yes. So Germany, if you wanted to have a word of Germany over the past 2 years, it's just stagnation. I mean, it's been really dire scenario. Exports are down, and particularly, it's sort of folly sometimes to always look at the most popular markets, because there's a whole world that doesn't get noticed and that goes on supplying other industrial producers. But when we look at the German car industry and its exports, particularly to China, I mean, they've just absolutely nosedived, and it's been a real knock to the German economy. So the German government, partly fighting back against that, partly sort of getting on more of a war footing, they are going for a really expansionary policy, pumping money into defence and pumping money into infrastructure. So again, whereas I said UK, just look at growth.
Yeah.
For Germany, I'm back to looking at inflation. So we've had this sort of stagnation, which has been obviously causing little or no inflationary impact. But with this spending, we're going to see bond yields likely rise. So if they're rising, that's going to make things more difficult for the economy. So Germany, my finger, again, it's nothing to do with GDP, whether I'm investing in the DAX or not. Inflation up, I'm getting out of the DAX.
All right. And last one in Europe, France.
France, again, similar to Germany, it's not been a happy place over the last few years. And I think when we look at the CAC and what that's been doing, for the last sort of 2 years since early 2024, we've got to this where we are now. Actually, all the indices have obviously had a strong start to the year. We get to just above 8,200, and then we stop. And it's almost been this sort of glass ceiling for the last few years. So I can't see, my personal opinion, I can't see any real reason to break through that ceiling at the moment. They've got a 5% budget deficit, which is just astounding. In France itself, they have some brilliant export industries. When we think of the sort of the companies like L'Oreal, etc., the luxury sector, it's fantastic. So my play is looking at the stability there. That if we get a bit of government stability, let the government letting us know they're not going to solve this 5% GDP deficit by going after the big multinationals that are based in France. If they're not going to do that, I think the CAC can go higher. But there is this sort of worry: are they going to go for a bit of land grab and say, right, we're going to put extra taxes on the only real sort of good growth that is there in France?
Okay, so let's put Europe aside. Let's go to the U.S. now. More specifically, I should say, the labor market.
Yes. So this. Again, I think that, apart from the UK, I think the signalling, this is almost the biggest thing for me in the world economy at the moment. It's the sort of the labour market momentum, what's happening. Yeah. So we had data out earlier today, Challenger job cuts. That it was meant to be 12:30, but it's already out. So we've had an early look into what's going on.
That's new.
So we had, so this is in terms of cuts, we had 35,000, which was the lowest cuts since July 24.
Okay.
And then when we look at December job growth, not many people hiring. It's not a major month for hiring. I think it was 10,000. It was the sort of most hires in December since 2022. I know that's not a long time ago, but both of those are really good signals for a strengthening job market. And again, as you would say, I'm often contrarian. I'm worried about this. So. Catherine, our head of strategy, when we were speaking about a year ago, Catherine was very much inflation is the big worry for 2025 in the US. And actually it didn't materialize, which Donald Trump was obviously extremely happy about. So as I said, didn't really materialize. So when we're explaining why inflation was kept under control, or at least why I think it was, we had planned layoffs at their highest since 2020, COVID, and of course that was pretty extreme. So it's hard to be greater than that in 2025. And actually, hiring was its lowest in 2025 since 2010.
Okay.
So the job market last year was in a pretty terrible state. Yet we still had, I think, inflation was averaging about 2.7%. It was pretty consistent. So to me, that was what kept inflation under control. We didn't have that sort of that job market growth, which is going to push up wage inflation. And as I said, when we've just had the December stats out today, we're seeing the job market improving, which I suppose is probably a good thing. Yeah, but in my eyes, actually, it's a reason to be keeping a firm eye on inflation again. So first of all, job market. And if the job market is changing, that will give you the signal before inflation even moves. So, so sometimes I talk about Germany where we're just looking at inflation. Here, I don't think we even need to look at inflation. We just need to look at the job market. And so we've got initial jobless out today, so that'll be out by the time this video is out. But then the big one is going to be tomorrow when we've got the non-farm payrolls. So where many people may be thinking, oh, if it's a big number, really good. Yeah. Actually, big number is going to be a return to sort of inflation and inflation fears, which I think will be stifling the economy.
Well, we'll have to keep an eye on those numbers tomorrow. Thank you so much, Alex. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.